Hello, everyone. Thank you for joining us today. We are back with one of our favorite partners, Vouch, for another webinar all about getting and protecting your startup, in the best way you possibly can with insurance. Startups are rare kinds of businesses or different businesses that run differently than your standard business. Oftentimes, something not much more than an LLC or sole proprietorship can have you off and running, and you don't really think about insurance outside of what you're forced to do if you have physical space or, just to get a permit or something like that. But startups are a whole different animal. Their insurance needs scale depending on their industry. They scale depending on the stage, acquisition costs, if they raise funds, the kinds of people involved in the startup. And it can be very complicated to manage on your own. And often if you go to traditional insurance companies, you will get a PDF that's like 5 pages long, and you'll fill it out and the answers will be vague and it'll be strange. And they'll have like a couple buckets of policy. One is way too expensive for you, and the other one seems like you're not going to get protected about for anything, if something actually goes bad. So you're kind of left being like, did I do that right? Should I have done that at all? That's why we partner with Vouch. Like we always say, an ounce of prevention is worth a pound of cure. Similar to our philosophy, they have broken out the insurance roadmap specifically for startups to allow you to more granularly pick out, what is a good fit for you at the milestone or the inflection point in your company. And today we are joined by Chris Maggio and Sebastian Schmidt from Vouch again to run over kind of the roadmap for growth-oriented companies. So we've done kind of a one-on-one with these guys before, but being that we're in kind of the scale phase of our curriculum programming, now we want to focus on companies that are definitely built for growth and climbing that trajectory, and what are those inflection points and milestones that they want to consider to add insurance coverage, so that if they've created something somebody wants, if they actually have something of value, they're not in danger of losing it through some unplanned incident or some crazy thing that happens. So as always, we're recording this. We'll send out the recording and any materials that Vouch provides a couple days after the event. Please engage with us, use the chat, use the Q&A. If you have questions, you want to post where you're coming from and where your startup is or what your startup's name is, please feel free. It should be open for everyone. And we'll do some time for Q&A at the end. And I might interrupt these guys if there's a really relevant question that shows up in the chat while we're going through this stuff. So I'm going to pass this over to Sebastian to do the intros for their team, and we'll get to it. Thanks for spending time with us.
Thanks, Ryan. Appreciate that introduction. And one thing that you mentioned in the intro there that stuck out to me was just most people, you find yourself growing and scaling, and suddenly you have a host of issues that you didn't foresee when you were at an earlier growth stage of the company. And we see that come through in that first-time finders almost never purchase any insurance. Those risks are just very, very tertiary to all the other focus items at the beginning stages of a startup. But 70% of second-time founders do buy business insurance at incorporation. And that's because once you've been through the ringer, you realize that stuff just comes up that you can't foresee. And it's better to be protected. And while you're in those scaling stages that expose you to so many different risks. So we'll talk a little bit more about the roadmap for growth from the lens of the business insurance in today's presentation, and we encourage you to ask any questions throughout the presentation. We'll make sure that we get them responded to. So let me kick off. I'm Sebastian Schmidt. I lead our platform partner channel at Vouch, and I'm very excited to be partnering with Chris Maggio, who's one of our risk experts from our insurance advisory team at Vouch, and he's going to do a lot of deep diving into a few of the different policy types that are crucial to consider as you start scaling and growing your business. And we'll finish with the Q&A section, as I mentioned. So as you look at we may be talking to an audience that has a company at various stages along the growth journey. And so at Vouch, we like to think about it, thinking about the problem that we're here to solve at Vouch. And we see that over and over again, that in the early stages, companies' risks are fairly predictable. You can understand what policies are generally applicable. And insurance it's a critical safety net, but at the end of the day, your requirements are going to be very contract driven. Your first office lease, your first employee that you hire, working with the first big customer, those are going to drive your needs. But your needs are going to be fairly simple at those early stages. You just want a responsive advisor, simple policy management, and good terms at a decent price. But as your business grows and you find yourself at a critical moment in time where your approach to risk management has to evolve, and you start to more seriously evaluate the trade-offs of different programs, and you have to understand your exposures become harder to quantify, and the stakes are higher for getting decisions wrong. And that's the stage of company that we want to ensure that we're providing with the right tools and risk management programs to make sure that those you're making the right trade-off decisions there. And so that's what we're here to chat about with you today. Now, as founders, a critical part of your job is to protect your business from risks. It may be seen as secondary to help it hit growth targets, make sure you're hiring the right employees and team. But risk management is a critical portion of your job, and is simple to overlook when there's so much else going on. Now, to make it a little bit simpler, we at Vouch think about a simple matrix to help manage the risk that you may face across, and this matrix is applicable across virtually every type of risk that your business would face. And we look at it in 4 quadrants, basically going from a low frequency event that doesn't have a lot of severity to it, all the way to a high frequency event that has a really significant severity. Now, you have a few tactics based on where that risk falls within this matrix. So for a high frequency event that has a significant amount of severity, you might choose to never think about and avoid that type of risk entirely. Or on the opposite side, a low frequency event and that has low severity, you might just accept that there occasionally will be a penalty associated with or a cost associated with it. And you can apply this framework of how to handle a risk across all sorts of different types of risks. And we're going to look at an example in just a moment of how to apply this. So if you can think about how to manage possibly being victimized by a cyber attack. Now, the impacts to your business may be different based on your business and how much you are dealing with customers' PII or what you have at risk during a cyber attack. And obviously, this framework would have to be applied based on your individual business. But we look at the 4 quadrants of the matrix, and avoiding it would be you don't operate a business digitally. Probably not an option for most startups that are having to face this risk in the first place. You could mitigate the risk through implementing rigorous cybersecurity protocols, implementing multi-factor authentication for employees, completing your SOC 2. All of those will help to mitigate risk, but not eliminate completely. You could accept that and hope that you don't get any lawsuits, or build the reserves to help deal with any penalties that come along with that. Or you could transfer that risk, and that would be by purchasing business insurance. And we're going to talk about errors and omissions and cyber insurance coverages today to talk a little bit about what that option looks like. Now, our team advises our clients to go through quarterly risk management process reviews with across teams and their company to identify what keeps you up at night, prioritize based on severity and how likely the event is, think about what action to take, and then monitor that risk going forward to help. And this provides that simple framework that you can think about your risk through and help to make the right decisions to help protect your business from risk. Now, with that said, we're going to mitigate our own risk here a little bit by putting in a legal disclaimer that insurance is rarely cut and dry and simple in the business world. This is not your average homeowners or auto policy. Every company has a different risk profile. And we can speak very specifically about the Vouch coverages that we offer and can speak to them, but we won't speak for others. And so just calling that out right here. And with that said, I appreciate you guys all joining us today, and I am happy to hand things over to Chris to chat a little bit more about the individual coverages that are probably very relevant to your company as you're growing and scaling.
Awesome. Yeah. Thanks so much, Sebastian. Thanks, Ryan, for having us. It's a pleasure to be with everybody here today. So as Sebastian and Ryan kind of teed it up here, we're going to go through some important insurance coverages to be thinking of while you guys are going through stages of growth. So whether that be just launching your product, you're starting to get some sales through the door, sign on some larger clients or your first clients, whether they be kind of raising around what that kind of looks like, what insurance is going to be required at that point, what insurance is just good to have in place. So we're going to start with some coverages. My goal here today is to give everybody a good understanding of what those coverages are, so you can walk away from this meeting kind of knowing, hey, that might be relevant for my type of business that I operate here. This is something that I'm going to start thinking about at certain inflection points, and we'll give those to you guys as well here. So that being said, happy to just kind of dive right in here, Sebastian, if you want to hit that next slide. Awesome. So we'll go through coverages. The first one we're going to talk on here is errors and omissions. So we're going to try to keep this light and fun. I know insurance isn't everybody's first language or what everybody wants to talk about every single day. So start with kind of a high level of what these coverages are, and then hopefully get into more granular, and especially happy to answer questions if they come up in the Q&A here. But really, when it comes to errors and omissions, you can think of this as being designed to protect your company in a situation where your services or product causes a financial loss to a company, to a client. So we like to think of that as meaning a number of different things. So you can think of breach of warranty, negligence, misrepresentation. The big ticket item on this is going to be product failure. So especially if you're a technology company, technology related services are kind of your thing there, product failure is going to be a big one that we see a lot. So ultimately, this coverage is designed to help protect your business from financial losses resulting from lawsuits that you're wrapped into from potential errors in your products or services. This is going to be really essential if you have a product live in market. If you're beta testing and it becomes a requirement to beta test with a few different clients or customers there. And then really anytime that you're offering any sort of product or services or making some sort of promise or guarantee that your product or service is going to perform a certain way. That's when this is going to become really essential for you guys. And then also does show up in some contractual requirements as well there. So launching products or services, and then also relevant when you're raising a round there. So kind of diving in next here to some claims that may arise. So we just throw out a few basic examples here. So one would be, let's say you're operating as a B2B SaaS company. You're selling billing and invoice software, right? So after using your software, a client learns they've been sending incorrect invoices. There's incorrect amounts to all their customers, and they are going to wrap you into a lawsuit saying, hey, your startup made errors in the design and implementation of the software that we've been using here. An instance like that could be pretty scary, but our errors and omissions policy is designed to then come in, cover the cost to defend against those allegations, pay for legal fees, and then ultimately that settlement. Could also, in instances like these, pay for any fines or judgments that you incur as well. So maybe we're looking at another instance where, hey, you're building an AI platform that helps companies accurately price their products. So let's say in this situation, there's a bug. There's a 72-hour outage, your platform goes down, and one of your clients who relies heavily on your product is unable, because of that outage, to appropriately price their products. So they're suffering a financial loss because of this. They can't price their products, get that out the door because your platform's down. In an instance like this, again, that's where it's helpful to have an errors and omissions policy in place. If you get wrapped into a lawsuit because of that, this is designed to defend against those allegations, pay for things like legal fees, settlements, fines, judgments, etc. So those are just some relevant little claim examples, throwing it out there. Of course, not speaking to any business in particular, but kind of gives you a high level understanding of how these coverages might come into play. So moving along, we're just getting into how errors and omissions is priced. So you can kind of see here, and it's good to call out that there's a high variance by category and industry when it comes to pricing, not only this coverage, but I would say any insurance coverage in general as well. So different industries have different levels of risk and therefore different pricing for errors and omissions insurance particularly. So for example, a company engaging in the use of AI for medical diagnostics technology probably going to have a higher premium than just a general like B2B SaaS company helping e-commerce companies out. So it also does come down pricing wise to coverage limits that you select. Going back to industry, I mean, think of this as if you are buying more coverage, price is likely going to increase as well. So maybe you're starting out with a lower coverage limit. You can probably expect your price to be a little more favorable. As you grow, as your errors and omissions policy needs to grow with you and you need higher coverage limits, you can pretty much expect that premium to increase as well there. And then a lot of it's going to come down to size and age of your business also. So a product already in market with a lot of active users or customers is going to probably cost more, be a little bit more expensive to secure than if you're doing this right out of the gate with maybe a lower client count, customer count, or still in the testing phases of your product. So this is where having proper risk management procedures in place, think of like quality control and assurance or active testing with your product, and having those strong, clear guidelines and framework when you're defining project requirements and deliverables is really important here, as that's going to set you guys up for success as well. And then hopefully having that quality control and everything good on the back end is going to give you more favorable pricing as well when it comes to this coverage. So as we're talking about this, your needs for errors and emissions are going to change over time. So as your company grows, as you take on additional risks, it's just going to be something that you need to kind of keep up with. And that's, again, why we recommend an annual meeting with legal team, your insurance advisor, account manager at that point, just to make sure that you guys are in a good place when it comes to the appropriate coverage limits for your errors and emissions coverage. So what a normal kind of growth path might look like is somebody providing software, let's say development services to a client. So at the outset, company may only need a basic errors and emissions policy with a lower coverage limit to start. As the company grows, it's going to start working with larger, more complex clients, at which point that company is going to take on additional liability and need to reevaluate the coverage limit that they currently have. So it's an ever-changing, evolving process here when it comes to looking at your coverage limits. The company is probably going to start developing, marketing its own software products. Marketing itself has some different risks involved with it. Once you do get out there, marketing against larger incumbents can become a little dicey at sometimes as well. So that's when you're going to want to make sure that coverage limits are in line and that you have this coverage in place. And then it's also probably appropriate as the company starts to grow, take on larger, more complex clients. Maybe there's going to look at a little bit more client data or even sensitive client data, at which point it would make sense to start looping in other coverages as well, in addition to your errors and emissions coverage. And we can kind of get in here. Wanted to throw out just kind of a fun little question for you guys. Curious if anybody has an idea of what the average cost per errors and emissions settlement would be. Feel free to drop it in the chat, come off mute if you have any sort of idea there. Just curious.
Raise your hands if you want to come off mute. Ooh, we got 1 million in there.
Ooh.
10 million.
10. Wow.
I'm gonna guess 35K.
35K.
Kilometers.
There we go. 10K. Okay. I like the range we're getting here.
150K. Yeah. 250.
250. Good guesses, everybody. Good guesses. Should we reveal it to him, Sebastian? Should we kind of go?
I'm curious.
Yeah, we're all curious at this point. I was curious when doing my research, and Tony brings up a good point. It does depend. That's kind of our favorite saying in insurance world is depends. A lot of things are going to depend, but what we think and our kind of data reflects is the average cost, the settlement is in the ballpark of about 140K. Now, that's not including legal fees. So that's something else to consider here as well as, hey, there's probably going to be some legal fees on top of that 140K. So yeah, Leanne was probably closest, depending again, what those legal fees come out to be, but 140K is average settlement cost for an errors and emissions claim. All right. So now we're going to get into cyber, and this is typically something that we recommend companies bundle either with errors and emissions or get just depending on the type of data that you're handling here. So this cyber coverage in general, we can think of this as being two-sided. So there's going to be something called first-party cyber coverage. I like to explain that as being for your system. So let's say in the event of a data breach, your system's compromised, data gets stolen, leaked, there's a hacker in there. First party is designed to pay for things like forensic analysis if you have to do any of that, software remediation on the back end, cost of notifying clients, maybe some PR costs in there as well, and then credit monitoring if you had to enact that. And then we can get into third-party cyber. I like to think of that as if you're wrapped into a lawsuit because of the data breach. So let's say that data breach leaks into somebody else's systems. They bring you into a lawsuit. That third-party cyber coverage is then designed to pay for things like legal fees, settlements, judgments, or any fines that you may incur here. It's really important as it becomes required again by customers and clients, investors, but also relatively very important depending on the type of data that you're storing. So again, kind of gets into the space that you're working in. If you're working for like a pediatrician, that's kind of your niche there, and you're storing a lot of minors, birthdays, social security numbers, personal information on a database. That's pretty sensitive stuff that you don't want to get leaked, and you're more than likely going to get wrapped into a pretty big lawsuit if there is any sort of compromise there. So people storing like payment information is a big one. Social security numbers is a big one. Now, let's say maybe you're a company that's not storing that much other than like first name, last name, email. Still a relevant coverage to have, especially in just the highly litigious environment that we all live in nowadays, but probably not as costly or as relevant to your business if you were storing that more sensitive kind of information there. There are going to be some claims that kind of continue to arise here. Basically, what we're doing here is let's say like you're a startup providing software testing tools and you have a data breach and attackers gain access to customer sensitive information, or again, going back to the AI, maybe you're getting some information there, some user adventures and unpublished post comments associated with usernames, that's getting leaked and shared into the public. So in both of these instances, thankfully, clients had a cyber policy in place, and the resolution is being that cyber policy is paying for a few different things here. So that forensic investigation to find out exactly how this occurred and what can you do on the back end to kind of remediate that risk. Some public relations advice, if this is going to go public and cause some negative news for your company, helping pay for some of that PR advice so you can get in a better place after this blows over. And then also helping the cost of notifying clients and they can conducting their own forensic investigation as well. So I think this last resolution is really important, especially with the AI-enabled text adventure gaming service kind of example, in that this coverage is also designed to respond to the cost to notify relevant parties. So that can help you out with like the EU's general data protection regulation, some certain regulations in the US as well here that this is designed to pay for. So maybe there's some subpoenas that come into play designed to pay to respond to those as well, which is really relevant and important in the event of a data breach. And we can kind of go on here looking at pricing again. And again, there's just going to be that high variance in pricing. So depending on size, stage, number of active users, the biggest one, I'd say the biggest factor when it comes to cyber pricing is the amount of PII that you're collecting. So that personal sensitive information that you guys are collecting or storing, whether it be on your own system or a third-party system. And then the measurements that you have in place to prevent against, or proactive steps you've taken to prevent against a potential data breach. So it's a relatively new type of insurance, which is unique. You might go to a traditional carrier and they may not really understand what this is supposed to do or be able to offer this for your company. So you'll see pricing vary pretty widely between certain carriers and insurers. Always, of course, kind of important to compare those quotes and read policy details carefully just to make sure that you're getting what you paid for and that there's no major gaps in coverage. Some things you can kind of do on the back end to, of course, help prevent against data breaches and then to make your cyber pricing more favorable would be things like implementing two-factor authentication, being SOC 2 compliance, a big one, some firewalls and data encryption. Those are all going to be good risk mitigation tools. And then constantly, I think, reiterating and training your employees on proper like phishing scams, instances like that too. is a good risk mitigation practice to help you evaluate where your business might be today, and then some gaps, areas you can improve to help you guys get a better cyber premium, and then also hopefully not have to deal with a data breach or a very severe data breach. And then, of course, this is going to kind of change over time as well. So contract requirements, especially when collecting sensitive customer data or signing on larger clients. And then let's say you're growing, you're expanding your presence. And then it does typically become a legal and regulatory requirement at a certain stage too, depending on the kind of business operations or business you're engaged in there too. So, and then as a fourth bullet point brings up, you just do become a more attractive target for cyber criminals if your company is having a lot of success, if it's pretty established and well known. Maybe they try to poke a few holes in there and see what they can get out of your company. So as you start collecting more sensitive customer data, payment information, PII, you're going to need those higher coverage limits, and those financial losses associated with the data breach are also going to be greater as well. So over time, company cyber coverage just is going to, again, need to continue and evolve as new cyber threats emerge. New cyber threats emerge pretty frequently, and companies' online presence and data protection requirements are always going to be changing as well too. So we like to think it's important for your company to regularly review your cyber insurance policy, work with an experienced insurance provider, and then also have an experienced cybersecurity team to ensure that you're covered up to date and adequate enough to protect against a financial loss in the event of a cyber attack or a data breach. And now we'll kind of toss it out here to groupthink. So throwing it out, curious if anyone has any idea. I'm sure someone out there's probably already secured this or considered securing this, hopefully, what the average cyber policy premium for Series A kind of company might be.
Are we talking per year?
Yeah, we'll talk annual here. We'll go annual premium. My math's not good enough to break it down monthly here, guys.
I have a PDF somewhere that I could go get you an example.
Yeah, right.
Answer, but I'm not going to.
I've done this. That's fair. That's fair.
Oh, yeah, make it clear. Throw it in the chat. Yeah. All right. We got 450 from Leanne, who was our champion on
I
the
know.
mic. I think she's making everybody nervous. Series A company. So for anybody who isn't familiar with the alphabet game, a Series A company probably has raised money in the tens of millions, low tens of millions of dollars at maybe a 3-digit or hundreds of millions valuation. You could probably go a little smaller on the scale too. Single digit high millions could be considerable in this environment. But you're talking, 80 to $150 million company valuation wise. I don't know if that's trued up with what you guys are thinking.
Yeah. I almost, we kind of phrase it.
675, 850, 10K.
I think pre-seed would have been interesting to see too here. What do we think? I'm gonna defer to Sebastian here on the data. He met with someone earlier, so he actually might have a better kind of range than I would.
Yeah. So obviously, as we said, it depends. So your individual company and characteristics would be taken into consideration to design the actual policy and get you a real premium. And like we dropped in the chat, you can go ahead and apply online and do that in under 10 minutes. But the average cost is going to be between like $800 and like $4,000 for this stage of company. So it's really wide range. And again, that, like Chris said, that depends a lot on the amount of PII that you're handling, what databases you use to do that, and the company size, like amount of revenue that you're generating. So a lot of a very dependent answer. But if you are curious, you can go ahead, apply online for free. You may end up within that application flow and be able to chat with someone like Chris about your individual characteristics.
I think the most interesting takeaway for this from somebody who's been in lots of different series startups, is even the top end of that is not destroying you. If you're a Series A company, you're probably making millions of dollars in revenue. And if the cost to cover that is on the range of, not even 10%, so much lower than that, it's like to to me, at that point, it's like, why don't you have this coverage? You know,
Yeah.
if maybe you're waiting until some big customer is trying to force you into to enter into a contract or something like that, and then it's just kind of like, you know, it's rote. But when it comes to coverage, it's like these things aren't, you know, breaking the bank, especially for the stage of company that, you know, could get protected by it.
Yeah, absolutely. And I think we talked about this on the last guest series, Ryan, but like that proactive versus reactive is a huge one. And I mean, once you have a claim, especially when it comes to like a cyber or errors and emissions, it's honestly going to be very tough to find any insurance company that's willing to write that insurance while you're in the midst of that claim too. So you're kind of out on your own at that point. So I mean, like we said, 800 to 4,000 on the higher range there. It does make sense at that point to kind of bite the bullet, maybe pay for that annual premium and set it and forget it. Hope that you don't have to use it, of course, but in the event that you do have to use it, that then is kind of cover you guys so you don't have to kind of go into your bankroll there or look at anything else. So it's a good coverage to have. And again, we typically do recommend bundling this with the errors and emissions as well, just because there's a decent amount of overlap between the two in a claim. Cool. So now we're kind of going into the directors and officers side of things here. So this is going to become especially relevant at that Series A funding round, typically becomes a requirement, but something that we kind of like to think of, again, being proactive is important here because it does help you attract and retain good talent too when you guys are looking for advisors or board members or adding executives to your team there. And really, this coverage is designed to protect your company, but then also the personal assets of your founders, officers, board members, etc. if you're sued over decisions you make on behalf of the company. Typically designed to cover the cost of legal fees, defense, settlements, judgments related to claims or wrongful acts. And then that can also include like alleged errors and omissions, breaches of duties by directors and officers as well. I think misstatements and misrepresentations is probably a big call out on this coverage also. And then this, again, designed to not only protect your company, but you as well there. So providing some financial protection for claims made against the directors and officers personally, as well as claims made against the company as a whole, which is really important. Again, like I kind of mentioned at the beginning, really important for attracting and retaining talented directors and officers. Repeat founders or officers, board members are going to kind of want to see this in place before they sign on to work with your company. Just because without this, there may be that fear of them getting personally wrapped into a lawsuit. This kind of helps tamper that fear, which is really nice. And then as there's a continued increasing scrutiny on corporate governance, just the rise in lawsuits against directors and officers, this is really nice and designed to act as somewhat of like a safety net to help mitigate against financial risks associated with any potential claims. So can also help protect the company's assets. Again, they're covering defense fees, legal fees, settlements, and potential indemnification payments, just really reducing overall the impact on the organization's financial resources, which is a good thing. And then it does demonstrate a good commitment to governance. If you can get this earlier on, does enhance your startup's credibility if you're able to secure this before it becomes just a contractual requirement. Going to look really good in the eyes of like potential partners, investors, stakeholders here once you have this coverage in place. But biggest catalyst, I guess I would say we see is close to that Series A funding round once it becomes an actual, hey, you need to get this kind of moment. So we can go ahead and move on to some claims that arise here with D&O. They're a little lengthy here, so won't have to go through everything, but let's say one example would be alleged technology taken from a competitor. So let's say your CPO was working at a competitor firm. He comes over to your startup to start it. And now that competitor is saying, hey, they stole some of our technology and they use that to develop. The CPO helped us develop that when he was working for us. In an instance like that, it is something that you see, especially going up against larger incumbents. The D&O policy is designed to provide coverage for the cost of those attorney fees to defend against the lawsuit. SEC seeking documentation is another one that comes up quite frequently. Think of that later stages, maybe even like IPO round kind of phases there. So in an instance like that, where the SEC, you receive a subpoena from the SEC seeking information for documents related to the startup's finances or customer list, this then designed to cover the cost of the startup's attorney fees, and then also to respond to those subpoenas as well, which is really nice. And then another one that, again, kind of comes up is a misappropriation potentially of trade secrets. So you're at the later stage in the project management software startup. They hire their CEO from a larger competitor. And then that larger competitor, again, going to come in, lawsuits filed against the startup, newly appointed COO, alleging misappropriation of trade secrets. That's a big one. Also, this policy, then the D&O designed to cover the cost of attorney fees, defend against the lawsuit, and hopefully you can have a settlement similar to this situation where you're settled after the startup's successful in early dismissal. But really important for a few reasons. It is designed to cover the settlement itself as well as those legal fees, which is really nice. Yeah, good to
I was
file
going to say
exemptions.
that we had a question on that. Nice job. Nice job.
Moving it in here, Ryan. I like your comment too. Yeah, good to file your exemptions is a big one there.
Yeah, we're very much in the, don't just raise money and not file your Form D because like we're in stealth or anything like that.
Yeah.
It's like, oh man, no one cares about your stealth mode. Just exemptions filed.
Exactly. And I saw Bryce's there too. So Bryce, it's a great question. And like, I assume maybe like working from like a PCO, MSO kind of like model there. We typically recommend that the MDs get their own malpractice insurance in place. Actually not going to be a proprietary product that we offer. I believe it might be some sort of like personal lines. I know that I'm not too familiar with it, to be completely honest, and not licensed to sell it or really speak on it. But always a good idea for the company itself to have airs and emissions, D&O, everything in place on that side. And then those individuals have their own underlying insurance as well, like malpractice, or if you're working with contractors, maybe their own general liability or E&O, things like that. Awesome. And then we can kind of go into pricing, and we'll throw it out again. It depends. So it's gonna kind of rely on a lot of different factors. We break it down into like a regulated versus a non-regulated industry sector. And then a big factor here is going to be the amount of capital raised. So the biggest factor probably is the amount of capital raised in the company's financial health, strong balance sheet. Things like that are going to have a large impact on the cost of D&O. But other factors such as like company size, previous claims, any pending claims, previous board experience or founder experience, and then also the selected policy limit that you choose are going to be big ones here. I also want to throw out this is a little confusing, the diagram here. Don't think of it as being like, hey, you've raised 0 to 5, it's going to cost $1 million. This is really kind of a glimpse into our coverage benchmarking guidelines. So let's say you've raised 0 to 5, whether it be non-regulated or regulated industry. Our typical recommendation at that point is a D&O policy with $1 million in coverage. We can think of Series A costs, again, kind of around maybe the 5 to 10K annual premium limit. If you're before Series A, pre-seed or seed round, going to typically be a little bit less than that 10K premium. So we can kind of go into this one. Your coverage needs are, of course, going to change over time. So early stage, so startups in the early stages typically have maybe some more limited resources, smaller executive team. D&O coverage at that point might not be as relevant to your company. So emphasis may be on coverage for claims related to like company formation or corporate governance is where your mindset's probably going to be, and then getting in those initial funding rounds. So this is the early stage is going to be a place where you might be taking a more proactive approach than a reactive, just saying, hey, I want to set myself up for success. This is something that attracts and retains good talent. Let's consider a D&O policy. So once you're at the growth stage, this is going to be where it becomes a lot more relevant, and sometimes that contractual requirement. Your needs have evolved at this point, and maybe you're increasing the number of directors, officers, employees, etc. You're trying to protect a larger group of people. And then we're also going to try to extend the scope of coverage. So to include risks associated with like rapid hiring or managing employees, and regulatory compliance at this stage is going to be a big one too, as the company becomes subject to more legal and governance obligations. And then pre-exit, pre-IPO stage, this is where you really need this coverage. This is a must at this point. You might want a D&O coverage that includes specialized IPO related endorsements if that's something in your near future, and then expanded coverage for things like security claims, increasing those policy limits to address the unique risks and increased liabilities associated with the IPO process. And then at this point, you again are just really focused on attention on protecting directors and officers from claims related to the financial disclosures at this point, prospectus misrepresentations, and then those post-IPO governance matters. And then especially once you go public, hopefully everybody gets to that stage. It'd be awesome. Company's going to face, again, a lot of really heavy regulatory scrutiny, and then you're going to need to protect against shareholder class action lawsuits potentially, and then substantially higher policy limits at that point as well to just protect personal assets of directors, officers, founders, and the company as a whole. I appreciate everybody listening to my spiel here. I know, again, insurance isn't the most fun, but I hope everyone kind of has a better, higher understanding of these important coverages and certain inflection points when it makes sense to get them. We're happy to be resources for you guys here as we still have a little bit more time on the call, and just field any questions you may have.
Yeah, I'll grab some from the chat. And like I said, feel free to use the Q&A functionality if you want to be sure your question gets answered, because that means we don't have to scroll through the chat to find it. Going back, we were talking to him a little bit in the chat, but Tony's got, and I'm sure you guys get this question all the time, he's got a expanding business that's based on brick and mortar, but it's growing bigger. It's not necessarily going to be, you know, an IPO company. But one, where does Vouch fall in line for insurance for companies like that? And two, as insurance in general, like what kind of insurance provider should somebody with a brick and mortar store with a lot of growth pursue?
Yeah,
knowing that it's not legal advice.
yeah, no. Big disclaimer there, no legal advice. It's a great question, Tony. And for more brick and mortar, I guess I'll speak for Vouch. We're more so on the technology focus side of things there. So I'll say it's rare that I have somebody with a lot of brick and mortars to kind of cover. I would think commercial general liability would be a huge kind of coverage for you guys, just actually covering the space itself. I would probably go to a more traditional sort of insurance company for something like that, like a Hiscox, Lloyd's of London, somebody along those lines is probably going to have better insight into what exactly it is your operations need. Whereas Vouch is, I guess we'd say, more like on the technology focused centric side of things here. Sebastian,
Yeah, and I have a kind of a follow on to that, because he indicated like his business was in an industry adjacent to an industry that has some unique risks, notably firearms and shooting ranges and things like that. I know while a brick and mortar store, that's a little different, but in terms of technology, startups are often trying to change norms, right? Inventing new business models, I know we had somebody on one of the previous webinars that actually found that they got coverage through your program when they were struggling getting it somewhere else, was doing a lot of interesting things with AR and VR, which could have, you know, claims-based things. You know, if people are using VR devices, like, you know, as clients, you know, I'm sure, you know, the VR places down in the city probably have all sorts of coverages against if you punch a hole in the wall or like trip. But what do you see in terms of disruptive industries, you know, industries adjacent to things that are higher risk? Obviously it depends, but like, what is I don't know, what is Vouch's kind of advice, I guess, or, you know, founders that are creeping into industries like that might be uniquely higher risk?
Yeah, it's a great question, and something where you're probably going to see just a mixed package of product offerings. So what's really, I think, great and unique about Vouch is that we have our proprietary products that may be more tech focused, but we also do have a brokerage arm, which allows us to also open it up and secure those more traditional kind of policies for people in maybe, let's say, like multiple spaces. So you could be we'll go to like the VR AR kind of company in an instance where, hey, you need to cover the tech itself, but you're right. What if someone does punch a hole in the wall or something? Vouch's policy may not be appropriate for that, but what we're able to do is go out in the legacy marketplace and secure something like a product liability policy that's more broad, going to better kind of cover those risks if you're in kind of a mixed space or an emerging market. So if someone does punch a hole in the wall, you have that other policy in place. It's like, hey, your product caused harm to somebody or something. Maybe there's some coverage for that. But let's say on the flip side of things there, hey, like all their data was hacked and now everybody's usernames and comments and stuff is swirling around in the interweb. That's where it's more relevant for like a cyber kind of policy. Like that's going to come into play. So I'd say it's a mixed bag. I think finding an insurance company where you can get a good mix of both, where they have the tech capabilities and then also those more traditional capabilities, is a really big key feature for like a company like that. Right.
Yeah, I actually didn't know that you guys offered that. The brokerage model is cool because I have seen, especially now, like a lot of companies that I would qualify as a technology company, right? It's like a Delaware C Corp, they raise funds from investors. I know one of the ones that was with our partner Seed Invest, where they're building omnidirectional treadmills for like VR games and things like that. So they're raising funds like, a licensing company, a product company. But one of their go-to-market distribution strategies was like these physical cubes that they would shift to convention centers to like have a bunch of people try out their stuff. And I'm like, oh, that could have even been a completely different business unit, and probably covered under completely different insurance policies, because the nature of, selling a product online, you get all the coverage on that, but offering, something with the conventional and experience. So that is really cool to know. All right, we got questions coming in here now. Any malpractice insurance if it's a health tech startup for the
good
doctors?
And not that we're able to provide, kind of gets into the mix of that's something hopefully the MD already has in place or is able to secure personally. Again, always kind of good to have that overarching kind of coverage through the company as well, just in case there. And I say that for contractors as well. If you're a company that contracts out, important to kind of vet that they have general liability and errors and omissions in place as well for themselves personally while doing work for your company. And then Ryan, I saw the question from Brandy also. I know we were talking about like, hey, spaces here and moving into spaces. So Brandy, it kind of depends on your situation. If you're in your space that you like own or lease, a general liability policy for your company at the company address is going to be sufficient to cover against any potential like bodily injury or medical costs. But if you guys are going out elsewhere and kind of renting a space for a specific amount of time, I've actually found a cool site called Event Helper. Real quick and easy. It's kind of like a general liability policy for just a specific amount of time. So you can even put in like, hey, I'm renting this space from noon to 9 p.m. I need coverage for 30 people. We're serving alcohol, and they'll be able to kind of generate a quote for you, which is nice. So kind of depends again. If you're actually at your office locations, your general liability would hopefully come into play there for those instances.
Yeah, I find it funny. It's often one of the first insurance policies I see startups get is when they get a WeWork, because there's like a base level, like the WeWork's like, no, you need like basically slip and fall insurance. And it's like, it's not much at all, but it's like, you just have to have that policy before you can actually occupy the office.
Just have to have it. Yeah, no, slip and fall.
Yeah. Leanne asks for a repeat on the cost estimate for directors and officers insurance, and then any insight on, I believe we gave it as a Series A company, but any insight on pre-seed and seed stage companies, and do they generally have it?
Yeah, I'd say pre-seed probably. It depends. I'd say probably closer to like 1 to 3K annual premium there if I had to guess, for 500,000 in coverage to $1 million. And then that Series A is probably going to be in the range, depending on the amount of capital you've raised, closer to like the 5 to 10 plus range for annual premiums. The biggest factor I'd say is just the amount of capital you've raised there. So if you're raising 20 million, it's going to cost a lot more than you're coming through and trying to get it at 25,000. You just are bootstrapping it.
Great. Bryce has another good question. Is there a standard revenue threshold to get to before considering errors and omissions?
It's a great question, Bryce. I guess I would say no, of course it makes sense to have the revenue in order to pay potentially like a retention. I'd say that's probably the threshold. I don't think you'll find that anybody's going to limit you or say you can't purchase this policy. Again, I think it actually comes down more so to like being able to pay your retention in the event of a claim, having that revenue in place, and then also having it kind of make sense financially to afford the policy on an annual basis too. So if it's pre-revenue, pre-launch, no clients, you guys are in a building phase, I'd say hold off until you get those first customer contracts probably.
Yeah, I think one of my favorite brain shifting perspectives on the startup space and people's concerns about lawsuits is like anybody can sue anybody at any given time. Like you do not need to have like a material event happen that is like, oh, this is grounds for a lawsuit. It's like you can go sue your neighbor tomorrow for whatever made up thing you want to. And it's whether or not, you know, it's you want to go through the process of doing all that stuff. You know, you're going to risk your own capital and, you know, hedging a lawsuit based on something completely fake. So it's really like once you feel like you've created something that has value and you want to protect it in the case that somebody could make a case that would actually be enough to warrant some kind of costly action. So
yeah,
I would consider, say you're a product that's not going to get to revenue for a long time, but you might have, say, advertising your business model.
Yeah.
That generally means you need millions of daily active users before you can make a dime. Nobody cares about you until you have massive adoption, which usually means free products, freemium service models, things like that. Even though you might not be making a penny of revenue and everything that you've done has been, you know, raised on, you know, venture funds or whatnot.
Yeah.
You'd still want to consider it like once value is created, because if a bug in your code results in like, you know, leaking, you know, a bunch of stuff, you know, that you were collecting, it's like you could still get sued and people could have a really good case, even though you didn't collect a dime from them.
That's a good point.
You know, yet.
No, I like that, Ryan. I'm going to have to start using that. I do like that.
Well, it's something because people want finite answers to vague questions all the time in the startup space. And it's really helpful to be like, nothing is certain. Everything is uncertain. All you're trying to do is build layers of protection around things that you create that have value. So that should somebody make a case and go out and sue you, you know, whether it's, you know, a board member turns rogue or a spurned investor or customer, like the more ammunition they give them by not building up your layers of protection. And this is everything from like filing your Delaware C Corp to working with Vouch to getting appropriate policies to like literally just getting good contracts and docs and terms of service or whatever you need. It's really, you're just kind of like building a shield for the eventuality so that when somebody would look from the outside and say, I'm going to take that person to court, it's like, ooh, that's a really thick shield. That's probably not worth it. Settle elsewhere.
Exactly. Oh, I love that. Okay.
We got one here from Abdul Kadar. Hang on a second, I have to read this first.
Yeah, please.
Oh, is there such thing as over coverage?
I'd say so. Yeah, there is such thing as over coverage. I think in most instances, it's going to be pretty apparent when you get into kind of what that premium looks like when you're asking for a $10 million limit and you don't have any product in market yet. I'm sure there's probably a pretty decent sized initial sticker shock seeing that and going, whoa. We do, thankfully, after working with thousands of startups in the tech space, have some coverage benchmarking guidelines. I'm sure a lot of companies are pretty similar in that too. It's like, hey, this is what we typically recommend for a company your size. Now, of course, at the end of the day, it is ultimately up to you, the founder, to kind of make those decisions. If you want to maybe overinsure, go to that next tier of coverage, or take a little bit of a risk there, self-insure to an extent and purchase a lower coverage limit. So I'd certainly say there's like, you could go overboard with too much coverage and paying for something you're probably never going to use.
I also lean into your quarterly insurance reviews with just you and your team, is to be sure. I find a lot of times inertia can waste a lot of money, where it's like, say, you know, especially in a startup when your business models are fluid, you know, say you went originally at, you know, B2B and you signed a contract, and to sign that contract, they required, you know, it was with a government oriented agency or a large stodgy company, they required excessive amounts of blank, blank, and blank, and you did it to get that coverage. And then your business model changes and later you're monetizing completely differently, reviewing the coverages you have and realizing like, oh, wow, we don't need this anymore. We got this to meet, you know, a criteria on a, you know, an LOI or something like that is a good practice to get into, because it's easy to let expenses just continue to charge you as a consumer, as a business, as, you know, anybody along the way.
Absolutely. And I mean, to that point too, I always kind of advise that clients push back a little bit, you know, and sometimes those contract holders aren't willing to budge, but in a lot of instances, if you can present something saying, hey, a professional told me that this is reasonable for my current stage. I can get this tomorrow. A lot of the times they're just sending out a boilerplate kind of
Yeah.
requirement to everybody, and they're willing to move a little bit. Sometimes they're not, though. Sometimes you do have to just eat
Yeah.
it. But
that is a good thing. And even working with, professionals will let you know those kind of things. And we've had it where you literally get, the templated PDF with your company name's not even on it yet. And you're like, oh, you need 2 million coverage in this like weird thing. Like our company's barely that kind of company. It's like, oh, well, we put that in there for everybody. It's like, cool, we don't need
exactly. Some pushback's good.
Yeah. All right. What else we got? Oh, this is a great question. And actually, I think it answers a lot of some of the other confusing questions in terms of like, well, if I accept credit cards, I'm storing PII, right? Or whatever. So if you're using third-party companies like AWS to host your servers, or Stripe or Square to process your payments, do you need to get coverage to handle things like PII or payment holding, or is it the coverage from those companies that you can lean on?
It's a fantastic question. So I think it's relevant to still secure the company. I mean, the coverage yourself for your company, just because I'd be cautious to kind of read the user agreements and what you're signing onto and into when you kind of sign up with a Stripe or an AWS, somebody like that. Because I'm sure that to an extent they have some certain carvebacks of like, hey, at some point it is probably going to fall back on your company and you're going to be responsible for some portion of that. Or vice versa, maybe something gets so bad that it leaks into AWS's system. Like I definitely wouldn't want to be responsible for harming Amazon in any way there with their lawyers, and I'm sure insurance coverage is in place too. I think it's definitely relevant, and again, something you could consider maybe a lower coverage limit on if you are using a third party for credit card or data storage, which is nice. So not having to worry about storing all of it yourself and the costs and implications of storing it all yourself. I think still relevant though, just because I haven't read those user agreements or kind of what that looks like, but sure, there's some sort of carve back to put you on the hook just a little bit, even if it's just a little bit, for a breach.
Yeah, I think this is why it's great to have a conversation with somebody, so you can really, I think people get really confused as soon as the technicalities of, who's storing what. So it's like a lot of the value proposition of a company like Stripe is that you as a company never receive credit card numbers or store credit card numbers. So it's not like you're storing them on Stripe. It's like Stripe is processing the payments for you. So you actually, I can't remember what the compliance is that, if you were the one who are actually going to take the credit card number and process the payment, you have to get tons of coverage and regulations and do a bunch of filings and things like that. But if you're using that, that's like kind of an advantage. I think things get really dicey, and I see this I see this in pitch decks all the time, which is like, what's your security policy? It's like, oh, we'll use AWS. So we're like, we're secure. It's like, you can build incredibly unsecure systems on AWS. Like they let you just spin up servers and you could make them completely open to the world and like put the password as password. Oh, wow. Is that the bell? I didn't know we had a bell. So you really having the conversation, not just being like, it's not binary. It's like, oh, we're on AWS. So like data's not an issue. It's like, you can get your AWS database hacked. People get their AWS accounts hacked all the time because they leak their private keys, and robots on the internet just spin up massive amounts of DDoS attacks and things like that. So it's still worth thinking the coverage, even if you're using best in class partners, providers, cloud things, platforms, whatnot.
Yeah, agree.
I think we have one more question and then we can break. Is that good for you guys?
Yeah, it works well, right?
All right, we have an AI mental health digital assistant therapist that's in beta with a wellness center. They're discussing pre-seed investments. What kind of insurance do you recommend at that stage? I bet it's going to depend. I don't know if we could probably give that on the call here, but Chris and Sebastian, I'll let you give the default answer.
He's on to us. No, I mean, we'd be happy to kind of, I want to say, like, take a look at it and have you take 5-10 minutes to kind of go through a Mad Lib application. What we're likely going to do, since you're in stealth mode and our underwriters can't glean too much from just a website, is maybe ask for a 1-page or a pitch deck there. I think it does make sense to, since we're already over time, have a more in-depth kind of conversation with a licensed insurance advisor, whether that be me or somebody else on the team. I think it's a great space, but there's some coverages that we talked about today that are probably going to be relevant in the very near future for you. Definitely worth a conversation later down the road or with Vouch.
Yeah. And so I put it in the chat before, I'll put it in again. Thank you everyone for your great questions and attendance and participating. Thank you. Sebastian and Chris. But we have a partnership with Vouch. They'll actually say, if they can do a policy for you, there's a little bit of a discount they can pass on because of our partnership policy. But it is free to talk to them. They have cool tools on their site, just like we do, to help you kind of level set where you're at on your roadmap, and so that you can get only the policies that make sense. I've seen our customers come through and literally come out with just a couple $100, premium just to cover their WeWork thing, and that is a game changer, and it's a friction reducer too. Because if you actually proactively know your roadmap, you will have less conversations where you feel like the naive founder who's like, oh, wow, we've really convinced them that we landed that LOI. We just have to get D&O. What does D&O stand for? Like that in a meeting is like, ooh, confidence just kind of like got sucked out of the room a little bit. It's like, you don't know everything that you're talking about with your company. So it's a really good idea to just get that roadmap in your brain. Be wise to this stuff. It doesn't take every stage of the startup journey through our joint programming. And yeah, Chris, Sebastian, thank you so much for your expertise, time answering questions. To everybody else, we'll send a recording out in a couple of days. I believe Vouch will provide us with some links and slides, both to the discount and some of the resources that they provided, the calculators, all the things to help you out in assessing this and spending just the right amount of money to protect that cool thing that you're making, but not be too bogged down in it.
Exactly.
Thanks so much,
everybody. Have a wonderful rest of your week and look out for more from us.
Bye, guys.